Right. All right, good morning. Welcome to the webinar on the importance of audits for estate agents and attorneys. I'm just gonna give it about a few minutes for the other people who signed up to attend so that they can trickle in. All right, let's get started. Okay. Good morning again, and welcome to our webinar on the importance of audits for real estate agents and attorneys. I'm going to start off by just going through a bit of information about who we are. We are Brainmo, and our director, who also happens to be the speaker for today, is Marlon Mukuze, who is a CARA and a tax practitioner. We are a dynamic and professional accounting firm based in Midrand, and we have branches in Zimbabwe and the UK. And we call ourselves accountability partners, as we live by this daily. And some of the services that we provide include secretarial services, consulting, audit and audit readiness, internal audit, payroll services, human resources services, tax services, accounting services. Our speaker today, as mentioned before, is Marlon Mukuze, and I'm just going to hand it over to her so that we can get right into the webinar.
Okay, thank you, Hazel. Thank you, everyone. Welcome to our webinar. I know this webinar is also live streamed into our various platforms on our YouTube and our LinkedIn and Facebook. So welcome everyone, even and those that are also on our live stream platforms as well. So just to get started, the objectives of the seminar, we just want to talk about the legal requirements, of estate agents, and also legal requirements for audits for the ATEN as well. Then the trust account best practice, then also the audits or for both estate agents as well as the trust ATEN. And as auditors, as we are registered auditors, we also audit trust accounts. We're just going to briefly talk about the common audit findings for both ATEN and estate agents as well. So stay tuned so that at least we can go through this for the benefit of the growth of your practices. So just before we start, maybe we just have to know who is who, those that are on live as well. Maybe you can indicate, are you an estate agent? Are you attorney and managing director of a law firm or other? So just indicate that as well. Okay, I think so far we have 54% said other, maybe they are accountants for those particular firms, estate agents, and yeah, 60%. And I know from our LinkedIn platforms, I know a lot of people expressed interests there that might be largely in the estate agents. So thank you very much. So this will help us to know how we're going to take the direction that we're going to take on this webinar. Okay, thank you for that. Okay, I still see people are still voting. Okay, thank you. Thank you for that. So just to start off, so this is going to be a combination of estate agents, but the trust account principles stay the same in both sectors. They are almost the same in both sectors. So just to start off, the legal requirements for the audits of estate agents. So we know the Board Property Practitioner Act, the PPA Act, or the PPA is the primary legislation governing the estate agent profession. So, and the Property Practitioners Regulatory Authority, which is the PPR, PPRA is the regulatory board overseeing estate agents. So if you just joined us, this webinar, we're talking both about the legal audit requirements or the audits for both the ATEN trust accounts as well as the estate agents. So the PPRA issues specific regulation requirements regarding the trust accounts, including how they should be maintained, and the audit requirements of that, and how you should keep your records in there. So obviously, for both estate agents and trust attorney as well, the frequency of audits is actually 6 months after the year end for the client. So for estate agents, if your year end is February, you should be able to submit by 31st of August. Similarly, if you are also your trust financials should also be submitted by the 31st of August. So there are actually consequences with these audit requirements in both industries as well. So there are a lot of fines that can be imposed should you not submit that. So just to kick off for estate agents as well, they are required to maintain their financial records to ensure compliance with Section 48 and also Section 51 of the PPA, as well as Section 28 of the FICA, and that is to prevent and detect fraud and theft. So someone might ask to say, why trust accounts? When you talk about trust accounts, it's an account that you actually hold funds on behalf of clients. So you see that in industries like ATEN and estate agents, as well as FSPs, the financial service provider sector, they also keep trust accounts. So with that, there are added regulations or requirements for the trust account to be audited. So mainly it's for FICA purposes as well, for both estate agent as well as the trust, the attorney as well, to prevent and detect trusts and theft. Because you see, within trust accounts, that's where hiding can also happen, to say, no, this money is not mine, and someone can just see a deposit lump sum, the fraud. So this is to prevent the fraud and theft around that. That's why trust accounts are really audited in both sectors. So section 51 of the PPA we're talking about the estate agent now. So the section 51 trust accounts, every property practitioner business must open and maintain one or more separate trust accounts with a bank. So these trust accounts should actually contain reference to section 51. So for identification purpose, you can't say I have a trust account, but it's not even referenced as such. Is actually a requirement that the trust account should be referenced section 51 of the PPA. So the property practitioner must immediately deposit all trust monies held or received into those trust accounts. So obviously, like what I said, trust means confidence. So as a property practitioner, the clients, let's say they're paying their deposit, rent or deposit, they are having confidence in you keeping the money for them. That's the trust that is there. So section 52 as well, we're still on the legal for estate agents. So in section 52, investment of the trust money. Similarly, you see when we're talking about the attorney as well, it's almost similar. So investment of trust money, property practitioner may invest trust money that is not immediately required by the client in a separate interest-bearing trust account. So you can't, it's especially if you are holding deposits for long term, it's kind of good business ethic to go invest that person's money into an interest-bearing trust account. So if you're holding the money for longer, it also you look at attorney as well when you're talking about conveyancing a business. You need to, if you're holding that money for more than 90 days or whatever the case might be, you can invest that, and we'll talk about that in the section that apply to that. So section 53(2), compliance with trust account requirements, a property practitioner must retain all trust money deposited in terms of subsection 1 or invested in terms of subsection 2 of this, yes, until he or she is lawfully entitled to such money or is lawfully instructed in writing to make payment therefrom to any party. So you should be able to retain all trust money, because it's not your money. So you see, that's one of the common audit findings, that you see that when you are auditing trust account, someone has deposited money into the trust account, whether it's for something else or whatever the case may be. Remember, a trust, like what I said, you are holding that money in trust, in confidence that you're going to keep it and use it according to how it should be used for. So that's why this section is actually guiding that you should retain all trust monies deposited in terms of that subsection. So section 48 speak about the fidelity fund certificate. A person must not act in the capacity of property practitioner unless you are in a position of holding that fidelity fund certificate. So if you are in the business of selling property and all those rentals and in the estate agent, make sure you have a fidelity fund certificate, because if you are found trading without a fidelity fund certificate, it's a huge penalty and fine that you wouldn't want. So applying for that fidelity fund certificate, someone might just have a question about that. So regulation 15.4 states that every property practitioner to whom a fidelity fund certificate or registration certificates, as the case may be, must not later than 31 October of the year of expiry apply for a renew. So you need to continuously renew your fidelity fund certificate. It's a yearly renewal. And you cannot get it if you didn't comply with other section. You didn't audit your books So it's actually a requirement there. So a property practitioner can apply for FFC with the PPRA on the PPRA website as well, but there are certain requirements, like I'm saying, that you should have already submitted your audit funds, your audit reports. So audit reports for estate agent express the auditor's reasonable assurance opinion in accordance with the international standards on assurance engagement. So it expresses a reasonable assurance. So as auditors, we have to express a reasonable assurance on how you are managing the funds, or you are complying with certain regulations and the requirements of the act. So going to legal attorneys, what the legal requirements for audits, the Legal Practice Council is actually a national or statutory body established in terms of Section 4 of the Legal Practice Act. It plays a crucial role in regulating legal practitioners, both attorneys and advocates and candidate legal practitioners as well. So the LPC exercise jurisdiction over legal practitioner. They actually investigate complaints, they take disciplinary action where necessary if there is non-compliance with the legal practitioners as well. So that's the LPC, that's their duty there. So the audits for attorneys are performed to confirm compliance with Section 86, which is, we can read it with Section 63 as well, and Section 87 and 1 and 2. Of the Legal Practice Act. So South Africa Legal Practice Council rules, and also South Africa Legal Practice Council rules, the rules made under the authority of Section 95 and 95 1 and 3 and 109 of the Act, and reporting on the legal practitioners' annual statements on trust accounts and investment practice. So this is the legal requirement. Section 86, that's the one that talk about the trust accounts. So legal practitioners are also required to open and maintain trust accounts with the bank. If you are a legal person, you normally receive deposits. So these trust accounts must be used for holding and managing trust monies received on behalf of clients. So trust monies includes funds, if you are an attorney, held for clients, such as deposits, settlements, and other transactions that you'll be helping your clients with. So legal practitioners may also invest trust monies in accordance with provisions of Section 86. So if you look at both attorney and estate agents, you see that the common thing is the trusts. That's why it's called a trust account. So you are holding money on behalf of someone, or you are holding that money before you actually they have done the job that you need to do. So it will only be your money after you have completed the task that you are mandated to do. So if you are illegal, it's maybe for settlements, because as an attorney, you are a trusted professional that can handle cases, different cases. So deposit will be made into the trust accounts. Also, because maybe the public has that confidence that as a legal practitioner, you are governed by LPC and you're following the standards that you need to. So in the trust accounts as well, that's why they need to be audited. So Section 87.1, 87.3, this section actually further elaborate on the responsibility and the requirements relating to trust accounts. So if you are a legal or a property practitioner, you know that you being in that position, there are certain regulations or requirements that you need to adhere to. First of all, for example, Section 87, in this case, it emphasizes the importance of accurate record keeping and reconciliation of trust accounts, because at any given point, you actually see that you actually have to, the law, actually that section actually go further to say it should be reconciled, the trust accounts should be reconciled monthly, meaning to say, if you have money in the trust bank account, every single month you need to know, we need to reconcile to who is it for. For example, you have 1 million in your trust books. So who is it for? If you are not necessarily doing the reconciliation monthly, you know that you're actually breaching that section. So the section 87.1 emphasizes the importance of accurate record keeping and reconciliation of trust accounts. So section 87.3 deals with the accounting records that needs to be kept. You see, so if you have a file, which files need to be kept for each and every cases that you are handling. So the record keeping around trust accounts. And section 84 outlines the process for handling unclaimed funds. So you see that maybe there are monies that you can't even reconcile who was it for. So and that money remains as unclaimed. So that section deals with how do you deal with unclaimed funds. It actually states that after a year of receipt of the funds, and the funds must be paid to the Fidelity Fund at the end of the second financial year end. So which means if you have unclaimed funds, which means you need now to give it to the Fidelity Fund so that at least you say this way, the unclaimed funds, just in case they can be claimed somehow or there are complaints. That's why the Fidelity Fund is there to deal with those incidences. So that's section 87. So also on interest accrued on money deposited in terms of this section must, in the case of money deposited in terms of this subsection, be paid over to the person referred to in that subsection. So if you have deposited or invested money on behalf of a client, so you need to make sure that what is important for trust accounts is to keep trusts creditors accounts. So you can actually open different investment accounts for your different clients. So provided that 5% of the interest accrued on monies in terms of this must be paid over to the fund and invest in the fund. So you need to, okay, so this section is talking about, let's say you have unclaimed as well funds and that end interests sort of thing, that interest 5% should actually be accrued to the funds. So in terms of section 86, as provided for by the Rule 54, under the authority of section 95 of the Legal Practice Act, 5% of the interest accrued on money deposited during the course of a calendar month or on maturity shall be paid over to the fund or its nominee or on behalf or on before the last day of the next succeeding calendar month. So as an attorney, you need to be able to understand what the sections means in terms of how do you deal with the interest that accrue. And so this is what we audit when we are auditing, to say if there were interests, that was the interest accrued. But now I see these days the banks, when they're managing trust bank accounts, there's pretty much a linking where you find that the interest is already automatically paid and stuff like that, which reduces the burden of really knowing what you need to do in regards to those. So the Legal Practitioner Fidelity Fund is the fund is the recipient of claims made against the fund for compensation for losses alleged arising from theft of money or other property entrusted to a legal practitioner. So this fund, so interest in unclaimed funds are required to be paid over to them because for safekeeping, because it can come after 3 years, someone coming and go and complain. So this is where the monies are going to be paid from. So unclaimed funds are actually required to be paid over in the second financial year after receipt of the said funds. I think we spoke about that as well. So this is the legal requirements for ATEN. So I think if you, the same audit engagement as well, but the difference between ATENs and estate agents is for ATENs an engagement letter on legal practitioner trust accounts. So, but for estate agents, you actually have to audit both your financials and your trust records. Your financial statements need to be audited as well as the trust account records need to be audited. But for ATENs, the requirement right now currently is for the legal practitioners trust accounts to be reported on compliance with the Act and the rules in a reasonable assurance engagement as well within the scope of the standard on assurance engagement, which is ISAE 3000. So that's the major difference. So for estate agents, only audit the trust practitioner accounts, which means your trust creditors, your trust books, all things relating to, but your own personal business accounts, we don't really look at that and audit. That is not a requirement. So the auditor is not actually required to express an assurance opinion on the legal practitioner's annual statement so the auditor is required to express an assurance opinion on the legal annual statement of trust accounts, right? Which is but we provide a reasonable assurance, right? And we don't provide an assurance opinion. So there's a difference between that, because this one, reasonable assurance, is we are auditing according to the law. The assurance opinion is more powerful than the reasonable assurance, but this is guided as well. So we only provide the assurance on the reasonable assurance on the trust account. So the auditor is, however, required to report on whether or not the legal practitioner carried on the business on an investment practice. The auditor is not required to express an assurance opinion thereon. So when you're auditing trust accounts, it's actually guided audit per se, because the procedures that the auditor has to perform are already done and they are already there. So you'll be only reporting to say, was that an investment practice, yes or no, and something like that according to the laws. A legal practitioner's financial statements are prepared from the transaction that relates to the legal practitioner's business and trust accounts. So it should be actually noted that in terms of Section 34 of the Act, only advocates who hold a fidelity fund certificate are required to submit their annual trust statement as well. So if you are an advocate and you hold fidelity fund certificate, it is also important to note that as the trust bank accounts and the trust balances are not the respective assets and liabilities of the legal practitioner, there is no disclosure of those balances in the legal practitioner's financial statements. No, there is disclosure of transaction, including interest and or balances in the trust bank account. So it's not, remember, you are holding money on behalf of. So that money is not necessarily your asset, or it's not your money, and it's also not your liability. So it is actually important to note that the trust bank accounts and trust balances are not your assets. So that's why you are required to do reconciliation, so that at least you reconcile whose money is it. Unless if the trust, you have already done the work by year end or by month end, you haven't yet transferred your fee, you haven't yet raised the invoice for your fee. That's the money belongs to you. Then it is actually the responsibility of the relevant provincial office of the Legal Practice Council to examine the auditor's assurance report. So the certificate says also a lifespan, like similarly to that for estate agents of a year. Hence, yearly audits are required, as the council only issues a certificate upon receipt of the audit report, which indicates compliance with the rules and the Act. So you need to ensure that you always renew your fidelity fund certificate as well, like estate agents as well. So I think most of you know, the ones that if you are listening as an ATEN, you know the penalties and administrative fee for late submission of audit reports. So like now, we still have a month for you to submit your audit reports, a month, because it's almost June. So the administrative fee will be raised in terms of Rule 6. So you wouldn't want, I always say, penalty and interests wasteful expenditure, because you know exactly when are you required to submit your audit reports. Why don't you just put everything in order and submit rather than paying those penalties as well? So it's very, very important to note the penalties as well for late submission of trusts accounts for ATEN. Then we're going to go as well. Let's go back to just accommodate both of you. Let's go back to the PPR Act. So I think we mentioned that the PPRA stands for Property Practitioner Regulatory Authority, and they actually govern the business of property practitioner and referred to as BPPs. Right? And these are the entities in the property industry that sell, rent out, or who are contracted to carry out those activities on behalf of third parties. So in its governance, they require all BPPs to be audited and to be audited annually. However, we need to understand the exemptions that some BPPs can actually get for them not to be audited. So based on the characteristics of a BPP, it may be required to have its financial statements audited or reviewed. A review and an audit is actually two different things. So there is a difference there. So let's just talk a little bit about who can be exempted, who can be exempted in this case for the BPP. A BPP that has never received trust money, a BPP that no longer receive trust money, but a BPP that has the mandate, that has actually mandated processing agencies to process monies on their behalf, provided that the payment processing agent is registered with the PPRA and is a valid Fidelity Fund certificate, the one that we call FFC. So the payment processing agent operates a trust account that complies with the PPA. So if you are a PPP and you have mandated the collection of your monies and everything to the payment processing agent, what is important for you to look at does this payment processing agent have a Fidelity Fund certificate? Are they in compliance? So which means that the payment processing agent is audited annually and that actually submits the required reports to PPRA. Then you can be exempted from that. So it's very, very important. If you are dealing with a if you are a BPP and you are using a payment processing agent to collect the funds on behalf of your clients and stuff like that, because the BPP, the payment processing agents are required, they have the same requirements for audit, which means that money that they are collecting on your behalf, they're being audited on by the auditors of the payment processing agent. So let's also talk about what is an audit and a review. I think I mentioned that some BPP are required to be reviewed and some are required to be audited. An audit is a thorough examination of financial information of an organization, while a review is a formal assessment of the financial. So a review is less hectic than an audit. On audit, you go extensive, and actually the assurance that comes from that audit report, it's in assurance. We call it in the opinion. It's in you give in the opinion that gives a bit of an assurance rather than when you're doing a review as well. A review is like a conclusion of some sort. So an audit provides an independent assessment of financial information, while a review performed to provide an assurance on financial information. An audit covers a wide range of topics, including financial statements and internal control, while a review only focuses on the financial statements. So in terms of assurance perspective, the audit gives more assurance than a review. So who is required to be audited? So all BPPs whose annual turnover is 2.5 million, they are required to be audited and above. If your turnover, your revenue, your sales is 2.5 million and above, the financial statements need to be audited within 6 months. Or like what I said, the due date now is August. If your year end is February, if your end was December, the due date is June. All right? December, January, February, March, April, May, June. Yes, 6 months. So the audited financial statements do not need to be submitted to the PPRA. However, should be readily available if requested. So you don't by the PPRA or during an inspection. Remember, when you're doing the submission, the auditors, the audit submission for you are done by the auditors from the auditors portal. So you don't really upload that, but you need to have that, should that be required. So for review, if your annual turnover is less than 2.5 million, PPPs who are in possession of the trust account exemption, if you have an exemption, you can go for a review. Remember, you don't automatically get exempted. You need to apply for that. The financial statements need to be independently reviewed within 6 months of the financial year, end of the business property practitioner, which is 6 months as well. So that's the same due dates, which is August. I was saying August is next month. No. So we're actually in May, June. For those that have a December, the year end is June, which is now. But for those that have a February year end, is August. So the audited financial statements do not need to be submitted as well. However, you should always have those records should that be requested by the board. So the consequences of not submitting an audit report on time for the estate agent, this is for the estate agents. I think we also looked at the fine that is a 1,000 for non-submission. So reports not submitted within 6 months of the financial year end, you can actually have a penalty of 20 Rand per day for a period of 3 months. And sorry about that. So if the reports are not submitted after 3 months still, you attract a penalty, a penalty of 25,000 fine. And property practitioners whose auditors fail to submit the reports within 3 months of the submission deadline should expect a compliance notice from the inspection department with a fine of 25,000. That's a lot of money just for not submitting. But you as a property practitioner, you knew the deadline for that. So this is actually in addition to the 20 Rand per day penalty for the first 3 months. So first 3 months, not submission, you are accumulating 20 Rand per day. And still, after 3 months, you are going to receive a compliance notice with a fine of 25,000. So I think it's a wasteful expenditure. So the consequence of not handling a trust account as well properly. So if the audit highlight that you are not handling the trust account properly, trust accounts not properly referenced, designated as section 54.1, 7,500. So these are the penalties. The 25,000 I've spoken about that. So the PPA Act actually states that property practitioner must open and keep separate trust accounts for their clients' trust monies, and that these accounts plus the practitioner's business account must be audited every single year. So this is very, very important. So you wouldn't want to attract that 25,000, 7,500 for not properly referencing your designated accounts. So trust accounts records not reconciled balance on a monthly basis, both for, but for the 25,000 is for the property practitioner. Shortfall or deficit of trust monies. So you find out when you're auditing, you find that there's a deficit. You have 40 clients that you're holding deposit for. But if you calculate the deposit amount and the amount that is in the bank account, there's a shortfall. So as an auditor, you report that the trust accounts were not balancing. So you would actually have 25,000. Practicing without a valid FFC, Fidelity Fund certificate, 25,000. So these are the penalties as well that are relevant in that, and that you can incur should you breach any of those. So an audit does not include the preparation, which is very, very important. So you find that clients will think that since I have sent for management account preparation, that's an audit. Often clients mistaken that an auditor will take care of the audit and management accounts, but this is, however, against the standards that we belong to as auditors as well. As a preparer of financial records cannot be the same person that audit the books. So you find out that there should be two different people that perform that function. So it's very, very important to note that when you send your bank statements, it doesn't mean that the audit is going to be done. It's management account preparation. So let's talk about trust account management practices. I think this is it's not only for both attorneys, it's actually for both attorneys and estate agents. So segregation of trust funds, maintain separate bank accounts for client trust funds and business funds. It prevents mixing of funds and makes it clear what monies belongs to who. So if you are mixing, so actually if you're mixing, it's not allowed. If you are paying your other expense from the trust business account, you're actually breaching that. You should not supposed to mix. Trust is confidence. you have given confidence to keep that money. So it needs that trust funds trust funds account where you keep the client's money. So clearly identify trust accounts with names that include client names or meta names if you're an attorney, or simplify tracking and reduce the risk of errors. So if client Molen pays you, you have a client name there in your accounts that you say this is Molen's sub-ledger or sub-creditor's ledger. Do not mix your personal funds or funds from other clients in trust accounts. Clients' funds must be kept separately at all times. So this is principle number 1 of managing trust accounts. Do not mix personal funds. And for easy tracking, reference different trust accounts, maybe by the meta number or by the clients, so that at least you'll be able to know what balance is for this client at any given point. Maintain detailed records of trust funds transactions, including deposits, withdrawals, disbursements. A paper trail is actually crucial for accountability and audits. So prepare your trust account statements regularly. It's actually required to be monthly reconciliation. So this actually applies more, and it's actually a work as an advice, especially for those that are starting up in the industry. So you find out that they will be mixing a lot of things and the document are not really in order. So prepare trust accounts regularly, reconciling them to bank statements. This ensures accuracy and identifies any discrepancies. Keep copies of all bank statements, deposit slips, or withdrawals and other trust account documentation, as that is essential for audits and client inquiries. So if you are audited, now you see that you have a client or a creditor called Molen that did deposit money into the trust account, and you had your disbursements and all your other fees around there. When you are auditing how you disbursed or how you used Molen funds, if we select Molen as your creditor, you should be able to have those supporting documents of any withdrawals. Why have you withdrawn the money? Were you done with the work? Because we are seeing the money moving from the trust to the business account, and et cetera. So it's actually recommended, and it's a requirement to reconcile trust accounts, bank statements monthly. Regular reconciliation catches errors and prevents misuse of funds. So you find out it's not necessarily you, the one who will be using the funds, but misuse of funds. You thought Jacob's funds is 100,000, but you mix it with Molen's one and all those kind of things. So reconciling regularly makes you to catch those errors. So you need to conduct regular reviews as well of trust account activity to identify and prevent errors of or misappropriation of funds. Proactive monitoring safeguards clients' money. So you won't want a reputation of you being known for not really you keeping the trust books well. Otherwise, the confidence, the profession, especially for attorneys, is also professional practitioner, property practitioner as well, is that you're going to keep the funds that you are being entrusted with and use it accordingly. So you actually need to also implement a system of internal control, such as maybe a dual signature for large disbursements, for large practices. This adds an extra layer of security and reduce the risk of fraud from trust accounts. And you also need to use accounting systems to automate record keeping and facilitate the reconciliation. System can actually streamline processes and actually improve accuracy in your firm. So these are some of the recommended systems as well that we think you can use if you're an attorney. You can actually use PM Pro, AJS, but you can also get all of us so that we can recommend to see which one according to this that we've worked with, and we see that it's really doing very well. We also have quantum legal accounts there. These offer different pricing, obviously. Those are just estimates that are there. They provide comprehensive trust accounting features for legal cases, management, and good scalability of your firm. So general accounting software as well with trust accounting capability. So you find out that the systems that are normal systems that other normal businesses that doesn't necessarily have trust account use might not necessarily be adaptable to trust accounting right? So it's very important if you're a legal attorney, an advocate who is holding trust funds, you need to ensure that you have a proper system in place. If you don't have a trust account, no more QuickBooks, Sage, and all those accounts, they are fine. You can actually use that. There are also free options, but things for free, they don't recommend that pay for the value that you're getting. So they also have some functionality around that, and marketing and practice management, but that's not for trust accounting. There's Find Law that offers marketing and practice management tools, but not trust accounting features. So the pricing varies by the number of users. So how do you choose which software to use? Obviously, we are here as your accountability partners, as your accountants. You can just get hold of us, then we recommend to you which one to use. So, but these are some of the other, how you can also choose your firm size, the complexity cases that you handle. Large firms might need the comprehensive features of PM Pro, AJS, or Quantum legal accounts. Smaller firms might opt for Zoho Books or Wave. So depending on your size, we can actually help you in that decision making. So budget also, PM Pro, Quantum legal are generally more expensive than Zoho. So you also need to look at your budget. How much are you willing to spend for that and your specific needs? Because all attorneys are not the same. Some do different type of work. So you need to consider your legal case management, document management, or your local support that you need depending on your specific needs. So in conclusion, there are a lot of systems out there that are ideally specifically for firms, especially the legal firms as well. And you need to be able to do that, to look at that. So for property practitioners as well, we have PayPro. For streamlining rental collection, financial reporting. So this is also another system, or PropWorks offers a broad range of property management features. And those are the roughly prices as well. So the key features for PayPro: strong focus on automation, user-friendly. Yeah, so if you have trust account, know that your books are just not the same. So which means like any other normal, which means you need a special system that handles that. So that's very, very important. So they're looking at suitability. So PayPro, ideal for large agencies, right? So that's why other people actually outsource as well that function to others. So PropWorks, best suited for small to medium-sized agencies needing a broader range of property management functionality beyond just a rental collection. So choosing the right software depends on agent size as well, and your needs, your budget, and actually both offer strong solutions but cater for slightly different needs. So you need to look at your size, your needs when you are choosing the right system. But your accountants are there to help you in making sure that you are doing well in your practices, so that at least you, yeah. Okay, so let's just have a question there. Do you have a system? Do you need help? If you don't have a system, you can just say yes, so that at least we can recommend what you need to. If you are serious about growing your firm or your practice, you need to start to that's part of putting good controls in place for your firm, so that at least you will grow as a business. Okay. Okay, you can also chat there. If you need help, you can just send a message on the chat. Okay. Okay, I think this one was, okay, so I can't see but it's fine. Let me go to the next section because I can't see the poll anymore. The purpose and benefits of audit in just conclusion, because I am seeing that we are almost 9 minutes to 10. So the purpose and benefits of audits. So obviously, primary purpose, ensure proper accounting practice. Audits provide some assurance, and it's a way of giving you a hint of where you need to streamline your control as well. It can prevent and detect fraud or misappropriation. So the process of reviewing your records and procedures help identify any red flags that could indicate misuse of funds. And you know, when there's misuse of funds, if you're an attorney or a proper practitioner, it means risk to your business continuity. So you need that. So it also builds trust and transparency with the clients. So obviously with the public as well, regular audits demonstrate a commitment to transparent and responsibility of handling clients' money. So benefits for professionals, it reduces the risk of financial irregularities. Audits help identify and address. Actually, for us as auditors, if we are auditing the trust accounts is termed EBA, the board that we also report to, they put it as a high risk because we are auditing someone who is holding money for the client. So they are high risk audits. So the audits reduce the risk of financial irregularities. They help identify and address any weakness in your internal controls and actually highlight to say, because when you are as an auditor, I will give you recommendation to say, why don't you put this in place? It also acts as a way of improving your internal controls and your financial management. They can review areas where you need to put in internal controls and processes so that at least you grow your business. Then one key thing is, imagine your profession, you're not handling things well as an attorney, you're using your trust accounts to actually hide money laundering and putting it in there because you know that trust accounts stamped like it's not your money and all those kind of things. So your reputation can actually be damaged if you're not careful about that. So regularly undergoing audits demonstrate a commitment to ethical practice, your professional reputation and confidence as well. So these are the common, in brief, I'm going to rush through. These are the common audit findings that we always find for estate agents: missing or incomplete client identification documents. So you need to implement strict policy for verifying clients. You know, when you're receiving money from people, you need to make sure that you have their identity proof and all those kind of things. So inconsistent or inaccurate record keeping is something that is key as well. So we spoke about systems that you can use for your business. You can use your normal QuickBooks and Sage Online, your accounting system for the trust and records and all those kind of things. You need to make sure you also implement systems, utilize templates. You know, when you are our client and we can have a consultation and come up with templates to say, these are the templates that you can use. So also regularly reconcile trust accounts records with the bank to identify any and rectify those discrepancies. So delays in depositing clients' funds and also unauthorized disbursements of funds, lack of segregation of duties as well. These are the common findings in estate agents and also in trust account audits as well. You need to review your trust account statements and bank reconciliation actually every month. Verification of client ledger. So remember I said money for Molen might be sitting in Jacob's client ledger account. So by comparing them to the trust records, you can actually look at that and you need to put supporting documents. Testing of internal control related to client funds, trust account audits involve testing the effectiveness of attorneys' internal controls relating client funds. An example of an internal control could be reconciliation of the trust ledger and the trust bank account on a monthly basis. So it's very important to handle client deposit, verify proper identification, similar to that, dispersing the funds and record keeping practices as well, and also maintaining the safeguarding client confidentiality because we are holding documents for the clients. So that's the trust account audit procedures, handling of clients, deposit, disbursing of funds. So this is actually what the auditors will test. They will test how are you handling client deposits? How are you disbursing funds from the trust account? How are you doing your record keeping in your firm? How are you safeguarding the client confidentiality? So these are the common audit finding: missing or incomplete client identification documents. You see, inconsistent, so they are almost the same, similar to the business proper practitioners, or inconsistent or inaccurate record keeping, especially the major one with the trust accounts is monthly reconciliation. You find out that there are no reconciliation that are being done. Unauthorized disbursements of funds. someone can actually just transfer into the business account, but there's nothing that is proving why the funds are now moving from there. Is the work done? Is the mandates, their mandate for that money to be transferred? So that's unauthorized disbursement of funds. Commingling of personal or business funds as well. With the trust account funds, you find out that you are now looking and seeing some school fees being paid from the trust account. So those are the common errors, audit findings that we are finding. So inadequate safeguarding for client confidentiality, and also what we also picked out for trust funds is hiding of funds in trust accounts. Hiding of funds and saying, no, this was a client fund, but the client doesn't exist, but it's coming from your other dealings, and putting it in there to hide for tax and something like that. So those are the common audit findings for trust accounts. So due to time, I know I was now speeding and rushing. In conclusion, trust account audits play a pivotal role in ensuring responsible handling of client funds. Remember, as an ATEN or as a property practitioner, you are in a position of trust, right? So regular trust account audits are not just a compliance necessarily, but a demonstration of commitment to that ethical practice that you have vowed to in your board of you being an ATEN. They build trust with clients, they minimize, they actually minimize financial risks and enhance your professional reputation. So that's it from our side. I hope you have found this webinar insightful and a refresher of some of things that you know as well. Any questions? We are left with only 1 minute. Okay, in the absence of any question, we are going to invite you to our next webinar. I can't see hands or something, so if you can see anything, but if in the absence of that, due to time as well, our next webinar is going to be on the 7th of June, where we talk about the importance of registering for UIF in your organization and unemployment insurance fund for your people in your organization. So can connect with us on the numbers that are being displayed there. We are here to help you. And don't forget to visit our YouTube channel, Brain More Business Hub. There's packed information that you can eat from to grow your business. Thank you very much for attending this webinar. Okay, yes, so I think we are done. So thank you very much. Thank you, everyone. See you in the next webinar.
All right, thank you, Marlon. Thank you, everyone, for attending. We will send you a recording of the webinar so that you can view it at your leisure.